Question 1. In a property insurance policy, the provision that requires the policyholder to maintain a certain limit of insurance, typically 80% of the property's value, to receive full payment for a partial loss is known as the A. Appraisal clause, B. Coinsurance clause, C. Subrogation clause, D. Deductible clause. Answer: B. Coinsurance clause. The coinsurance clause is a provision designed to encourage policyholders to insure their property to its full value. This clause stipulates that if the property is not insured for at least a specified percentage, usually 80%, of its replacement cost at the time of the loss, the insurer will only pay a portion of the claim. For example, if a building worth $200,000 has an 80% coinsurance requirement, it must be insured for at least $160,000 to avoid a penalty on partial losses. The key takeaway is to remember coinsurance as a cooperation between the insured and insurer to share the risk of being underinsured. Question 2. Under a standard personal auto policy, PAP, which part covers damage to the insured's own vehicle resulting from a collision with another object or an overturn? A. Part A, liability coverage. B. Part B, medical payments coverage. C. Part C, uninsured motorist coverage. D. Part D, coverage for damage to your auto. Answer: D. Part D, coverage for damage to your auto. Part D, often called collision and other than collision coverage, pays for direct and accidental loss to the insured's covered auto. The key word here is collision, which specifically points to this part of the policy that protects the financial investment in the vehicle itself, regardless of who is at fault. For example, if you hit a telephone pole, Part D would cover the repairs to your car, subject to your deductible. A good way to keep the part straight is to think, D is for damage to your auto. Question 3. All of the following have an insurable interest in a property except A. The owner of the property. B. A mortgage lender with a loan on the property. C. A general contractor who has just completed construction and is waiting for payment. D. A person living next door to the property. Answer: D. A person living next door to the property. Insurable interest is a fundamental principle stating that an individual must have a financial stake or legitimate interest in the insured item to be able to purchase insurance on it. This means the person would suffer a direct financial loss if the property were damaged or destroyed. While owners, lien holders like mortgage lenders, and even contractors awaiting payment all have a clear financial connection, a neighbor does not have a direct financial stake in the property next door. Always remember, insurable interest means you have something to lose financially if the property is damaged. Question 4. Which of the following defines a claims-made liability policy? A. A policy that covers claims filed during the policy period, regardless of when the injury occurred. B. A policy that covers injuries that occur during the policy period, regardless of when the claim is filed. C. A policy that only covers claims made and paid within the first 30 days of the policy period. D. A policy that only covers injuries reported by a third-party claims administrator. Answer: A. A policy that covers claims filed during the policy period, regardless of when the injury occurred. A claims-made policy is triggered when a claim is first made against the insured during the policy period, even if the actual event causing the claim happened before the policy was in effect. This contrasts with an occurrence policy, which covers events that happen during its term, no matter when the claim is filed. For example, if a surgeon is sued this year for a mistake made 3 years ago, their current claims-made policy would respond, not the policy they had 3 years ago. The key phrase to associate with this form is, when the claim is made. Question 5. The legal principle that prevents a party from reasserting a right or privilege that they have already voluntarily given up is known as A. Subrogation. B. Adhesion. C. Estoppel. D. Indemnity. Answer: C. Estoppel. Estoppel is a legal doctrine that prevents, or stops, one party from going back on their word or conduct if another party has reasonably relied on it to their detriment. It often works in tandem with waiver, which is the voluntary relinquishment of a known right. For instance, if an insurer consistently accepts late premium payments without penalty, a waiver, they may be estopped from suddenly canceling the policy for a single late payment because the insured had come to rely on that acceptance. Think of estoppel as a legal tool that says, you can't take it back now. Question 6. A fire breaks out in a commercial kitchen, causing significant smoke and fire damage. Firefighters use a large amount of water to extinguish the blaze, which results in major water damage to the floors below. The water damage is considered A. Indirect loss. B. Direct loss. C. Consequential loss. D. Speculative risk. Answer: B. Direct loss. A direct loss is physical damage, destruction, or loss of property that results immediately from a covered peril, following an unbroken chain of events. In this scenario, the fire is the initial peril, and the water damage caused by the firefighting efforts is a direct and immediate consequence of that fire. The concept of proximate cause links the initial event, fire, to the subsequent damage, water, making both part of the same direct loss. Remember, if you can trace the damage in an unbroken line back to the covered event, it's a direct loss. Question 7. The part of an insurance policy that contains the who, what, where, when, and how much of the coverage is the A. Conditions. B. Exclusions. C. Insuring agreement. D. Declarations. Answer: D. Declarations. The declarations, or dec page, is the personalized, front-page summary of the insurance policy that provides all the fundamental information specific to the policyholder. It identifies the named insured, describes the property or activity being insured, lists the policy period, states the coverage limits, and specifies the premium amount. For example, on a car insurance policy, the declarations page will list your name, your specific vehicle, VIN included, your address, and the dollar amounts for each type of coverage you selected. Think of the declarations as the policy's unique fingerprint. Question 8. In a property and casualty policy, what is the function of the deductible? A. To determine the premium paid by the insured. B. To eliminate small, frequent claims and reduce moral hazard. C. To transfer the insurer's risk to a reinsurance company. D. To pay for losses that are excluded from the policy. Answer: B. To eliminate small, frequent claims and reduce moral hazard. A deductible is the amount of a loss that the insured is responsible for paying before the insurance company pays its share. Its primary purposes are to discourage the filing of minor claims, which are expensive to process, and to give the policyholder a financial stake in preventing losses, thereby reducing moral hazard. For example, with a $500 deductible on your auto policy, you would pay the first $500 of repair costs for a covered accident, and the insurer would pay the rest. A helpful tip is to remember the deductible, Dieter's small claims. Question 9. An insured's home is damaged by a tornado. While the home is being repaired, the insured must live in a hotel for 2 weeks. The cost of the hotel stay is considered what type of loss? A. A direct loss. B. An indirect loss. C. An incidental loss. D. A punitive loss. Answer: B. An indirect loss. An indirect loss, also known as a consequential loss, is a financial loss that occurs as a secondary result of a direct physical loss. The key is that the indirect loss is not physical damage itself but a consequence of it. In this case, the tornado caused the direct physical damage to the home, and the resulting expense of living in a hotel is the indirect loss because it would not have occurred without the initial damage. For businesses, this is often called business interruption. Always link indirect loss to the consequences that follow direct damage. Question 10. The failure to act as a reasonable and prudent person would under similar circumstances is the definition of A. Libel. B. Slander. C. Negligence. D. Vicarious liability. Answer: C. Negligence. Negligence is the central concept in determining legal liability and is based on the idea that every person has a duty to behave with a certain level of care to avoid harming others. To prove negligence, one must typically show there was a legal duty, a breach of that duty, a resulting injury or damage, and approximate cause linking the breach to the injury. For instance, a driver who runs a red light and causes an accident has failed to act as a reasonable person would and is therefore negligent. Remember that negligence is not about intentionally causing harm, but about failing to exercise proper care. Question 11. Which homeowner's policy form is specifically designed to provide open peril coverage on the dwelling and named peril coverage on personal property? A. HO2, broad form. B. HO3, special form. C. HO4, contents broad form. D. HO8, modified coverage form. Answer: B. HO3, special form. The HO3, or special form, is the most common type of homeowner's policy because it offers a hybrid of coverage types. It provides open peril, or all risk, coverage on the dwelling and other structures, meaning they are covered for all perils except those specifically excluded. Conversely, it provides named peril coverage on the personal property, meaning belongings are only covered for the specific list of perils named in the policy, such as fire, lightning, and theft. The tip here is to associate HO3 with the special combination of open peril for the house and named peril for the stuff inside. Question 12. If an insurer pays a claim for a damaged vehicle, it may then take possession of the vehicle to sell the remaining parts. This is an example of the insurer's right to A. Subrogation. B. Salvage. C. Abandonment. D. Appraisal. Answer: B. Salvage. The right to salvage allows the insurance company, after paying a total loss claim, to take ownership of the damaged property to reduce its net loss by selling the remaining parts or scrap. This right is directly tied to the principle of indemnity, preventing the insured from profiting from the loss by both keeping the insurance payment and the damaged property. For example, after an insurer pays you the full value for your totaled car, they are entitled to take the car and sell its parts to a salvage yard. Remember, salvage is about the insurer recovering value from the salvaged remains of the property. Question 13. Which of the following is not one of the primary coverages provided under Section 2 of a standard homeowner's policy? A. Personal liability. B. Medical payments to others. C. Damage to property of others. D. Loss of use. Answer: D. Loss of use. Section 2 of a homeowner's policy exclusively deals with liability coverages, protecting the insured against claims for bodily injury and property damage they may cause to others. This section includes personal liability, coverage E, and medical payments to others, coverage F. Loss of use, also known as coverage D, is part of Section 1, property coverages, as it pays for additional living expenses if the home becomes uninhabitable due to a covered property loss. The key is to separate the policy into its two main sections, Section 1 for your property, and Section 2 for your liability to others. Question 14. After an insurer pays a claim to its policyholder for damages caused by a negligent third party, the insurer has the right to seek reimbursement from the at-fault party. This right is called A. Contribution. B. Indemnity. C. Subrogation. D. Arbitration. Answer: C. Subrogation. Subrogation is the process by which an insurer steps into the shoes of its insured to pursue recovery from the person or entity legally responsible for the loss. This prevents the insured from collecting payment from both their insurer and the at-fault party for the same loss and helps keep insurance premiums down by allowing insurers to recoup their claim payments. For example, if your neighbor negligently starts a fire that damages your house, your insurance company will pay your claim and then subrogate against, or sue, your neighbor to recover those funds. A simple way to remember it is, subrogation follows the fault. Question 15. The provision in a property policy that specifies the insured's responsibilities after a loss occurs, such as giving prompt notice and protecting the property from further damage, is found in the A. Declarations. B. Insuring agreement. C. Conditions. D. Exclusions. Answer: C. Conditions. The conditions section of an insurance policy outlines the rules, duties, and obligations that both the insured and the insurer must follow for the policy to be enforceable. These are the ground rules of the contract, including requirements like duties after a loss, how cancellations are handled, and procedures for appraisal. For instance, the requirement to notify the police if a theft occurs is a classic example of a policy condition. Remember that conditions are the terms and conditions you must meet for the policy to work as intended. Question 16. A written modification that is added to an insurance policy to change the original terms, such as adding or removing a coverage, is known as A. Endorsement. B. Binder. C. Rider. D. Warranty. Answer: A. Endorsement. An endorsement is a written amendment or addition to a property and casualty policy that modifies its original terms, coverages, or conditions. While the term rider is often used interchangeably, especially in life and health insurance, endorsement is the standard term in P&C. For example, an insured might add a scheduled personal property endorsement to their homeowner's policy to provide specific, higher value coverage for items like jewelry or fine art. A helpful way to think of it is that an endorsement endorses or approves a change to the standard policy language. Question 17. Under the Fair Credit Reporting Act, FCRA, an insurer that uses information from a consumer reporting agency to make an adverse underwriting decision must: A. Obtain a court order to use the information. B. Pay the consumer a fee for the use of their report. C. Inform the consumer of the source of the information. D. Report the adverse action to the state insurance department. Answer: C. Inform the consumer of the source of the information. The Fair Credit Reporting Act, FCRA, is a federal law that regulates the collection and use of consumer credit information and ensures fairness, accuracy, and privacy. If an insurer takes an adverse action, such as denying coverage or charging a higher premium based on a credit or consumer report, it must notify the applicant. This notice must include the name, address, and phone number of the reporting agency that supplied the information, allowing the consumer to obtain a free copy of the report and dispute any inaccuracies. The core idea of the FCRA is consumer protection and transparency. Question 18. A driver swerves to avoid a deer, runs off the road, and their car flips over. What coverage under the personal auto policy would pay for the damage to their car? A. Collision coverage. B. Other than collision, comprehensive coverage. C. Property damage liability coverage. D. Uninsured motorist property damage coverage. Answer: B. Other than collision, comprehensive coverage. Other than collision, also known as comprehensive coverage, pays for damage to the insured's vehicle from specific perils like theft, fire, vandalism, falling objects, and contact with an animal. While an overturn is typically considered a collision, the proximate cause, the initial event in the unbroken chain, was contact with an animal, which is a specified other than collision peril. Therefore, the entire loss, including the subsequent overturn, is covered under comprehensive. Remember this key distinction: if the first event in the chain is on the comprehensive list, the whole claim falls under that coverage. Question 19. The Terrorism Risk Insurance Act, TRIA, requires that insurers make terrorism coverage available for certain commercial lines. What is the role of the federal government under this act? A. To provide primary insurance coverage for all acts of terrorism. B. To act as a reinsurer and share losses with insurance companies after certain thresholds are met. C. To investigate and certify which events qualify as domestic terrorism. D. To set the premium rates that all insurers must charge for terrorism coverage. Answer: B. To act as a reinsurer and share losses with insurance companies after certain thresholds are met. The Terrorism Risk Insurance Act, TRIA, establishes a public-private partnership where the federal government acts as a backstop or reinsurer for the insurance industry in the event of a catastrophic, certified act of terrorism. Insurers are responsible for paying claims up to a certain deductible, and once that threshold is crossed, the federal government shares in paying a large percentage of the remaining losses. This program ensures that terrorism coverage remains available and affordable for commercial policyholders. Think of TRIA as a safety net that protects insurers from insolvency after a major terrorist attack. Question 20. Which of the following is an example of vicarious liability? A. A homeowner is held liable for a guest slipping on an icy sidewalk. B. A surgeon is held liable for a mistake made during an operation. C. An employer is held liable for the negligent acts of an employee committed in the course of their work. D. A manufacturer is held liable for a defective product that causes injury. Answer: C. An employer is held liable for the negligent acts of an employee committed in the course of their work. Vicarious liability is a form of indirect, or imputed, liability where one party is held responsible for the actions of another. The most common example is the employer-employee relationship, where the employer can be held liable for the torts, wrongful acts, of an employee if the act was committed within the scope of their employment. For instance, if a delivery driver causes an accident while on a delivery route, the delivery company can be sued in addition to the driver. Just remember, vicarious liability means being held liable for someone else's actions due to a specific relationship. Question 21. All of the following are typically included as one of the 4 essential elements of a legal contract except A. Agreement, offer and acceptance. B. Competent parties. C. Legal purpose. D. Written evidence. Answer: D. Written evidence. The 4 essential elements required to form a legally binding contract are agreement, a clear offer and acceptance, consideration, the exchange of something of value, like premiums for a promise to pay, competent parties, individuals who are legally capable of entering a contract, and legal purpose, the contract's objective must not be illegal. While many insurance contracts are put in writing for clarity and to comply with the statute of frauds, a written document is not a universal requirement for a contract to be legally valid. Oral contracts can also be binding in some circumstances. A great way to remember the core 4 is to think, agreed upon consideration between competent people for a legal reason. Question 22. Which of the following losses would be covered under the medical payments to others coverage, coverage F, of a homeowner's policy? A. The insured homeowner breaks their own leg falling down their stairs. B. A resident of the household is bitten by the family dog. C. A visiting guest slips on a wet floor in the kitchen and requires stitches. D. A tenant living in a rented portion of the house is injured on the premises. Answer: C. A visiting guest slips on a wet floor in the kitchen and requires stitches. Medical payments to others, coverage F, is a goodwill coverage designed to pay for the necessary medical expenses of non-residents who are accidentally injured on the insured's property, without regard to legal liability. The key is that it does not cover the insured or regular residents of the household, as their injuries would be covered by their own health insurance. It provides quick, small payments to guests to avoid potential lawsuits, covering a visitor's injury but not the homeowners or a tenant's. Think of coverage F as for friends and guests, not family or residents. Question 23. A business owner purchases a policy to protect against lawsuits arising from bodily injury or property damage to customers, visitors, or the general public. This type of insurance is known as A. Workers' compensation. B. Commercial property insurance. C. Commercial general liability, CGL. D. Errors and omissions, E&O, insurance. Answer: C. Commercial general liability, CGL. Commercial general liability, CGL, insurance is the cornerstone of a business's liability protection, covering claims for bodily injury and property damage that the business may cause to third parties. This includes incidents happening on the business premises, through its operations, or as a result of its products. For example, if a customer slips and falls in a grocery store, the store's CGL policy would respond to the subsequent claim for medical bills and other damages. Remember, CGL is the public liability policy for a business. Question 24. Under a personal auto policy, Part C, uninsured motorist coverage protects the insured for A. Property damage to the insured's vehicle caused by an at-fault, uninsured driver. B. Bodily injury sustained by the insured caused by an at-fault, uninsured driver. C. Bodily injury sustained by the uninsured driver in an accident caused by the insured. D. Property damage to the other driver's vehicle when the insured is at fault and has no insurance. Answer: B. Bodily injury sustained by the insured caused by an at-fault, uninsured driver. Uninsured motorist, coverage is designed to protect the insured and their passengers by paying for their bodily injury expenses when they are hurt in an accident caused by a driver who has no liability insurance. It essentially allows the insured to collect from their own insurance company what they would have been legally entitled to collect from the at-fault driver. For instance, if an uninsured driver runs a red light and injures you, your coverage would pay for your medical bills, lost wages, and pain and suffering. The key is that coverage steps in to act like the at-fault driver's missing insurance. Question 25. The principle of restoring an insured to the same financial position they were in immediately prior to a loss, with no opportunity for gain or profit, is known as A. Subrogation. B. Indemnity. C. Adhesion. D. Warranty. Answer: B. Indemnity. The principle of indemnity is a core concept of insurance, stating that a policy should make the insured whole again after a loss, but not allow them to profit from the event. Insurance is designed to compensate for the amount of the loss, not to create a financial windfall for the policyholder. For example, if your 10-year-old roof is destroyed, an indemnity-based settlement, actual cash value, would pay for a new roof minus depreciation, reflecting its pre-loss condition, thus preventing you from getting a brand new roof for the price of an old one. Just remember, indemnity means to compensate, not to enrich.